Oh, this is Chuck Carnival. I'm the Chuck in the Markets Up, Chuck. And today, this morning, as I was eating my breakfast, I got to wipe egg off my face twice. First, from my breakfast itself, and next, from an article in the Wall Street Journal where Easy Corp had reported that they have reduced their earnings expectations for the next 2 quarters as well as the year. And of course, this was one of the companies I covered in yesterday's post. So synchronicity, really kicked in and gave me a nice little kick in the pants this morning. However, since I believe in every adversity lies the seed of a greater equivalent benefit, I thought it would be a great opportunity for me to point out, another important principle that really kind of relates and segues from yesterday's post. Easy Corp is a little company with no debt on the balance sheet. You can see it's a small cap company that is in the pawn business, mostly in the United States, but expanding in Mexico. And as you can see by their earnings record, over the last 19 years, it's been a little erratic in the first years, but really starting since 2001, this company has strung together a really impressive string of earnings growth. Overall, their earnings growth has been 18.6%, but that includes some of these early years here. Drop that down just since, 2003 or including 2003, and this company does have an odd fiscal year. You can see their earnings growth has increased up to 58.5%. So this company's had extraordinary growth, and then when you look at the record that they created over this last 7 years, they've generated over a 46% return to their shareholder, and that's during a time when the market only did 1%. Really an extraordinary little company, at least for the last 7 years. Now let's focus on their forecast a little bit. Prior to this morning, the consensus of the leading analysts following the company were forecasting this company to continue to grow at 18%. They forecast $1.51 in earnings for fiscal year 2009, which by the way ends in September, and then an 18% growth going forward. That put the price-earnings ratio at 9 times earnings, and even at their growth rate at an 18 multiple, this company would has the opportunity to generate an incredible long-term rate of return. We believe that this company is worth $29 a share and is trading at less than 13 through yesterday's close. So let's look at a quick quote on this company. I want you to notice the real-time quote here. The stock is now down to $10.82 real-time. It's down 16% at 11:30 a.m. on June 12th. The stock has fallen over 16% in the morning's trading as a result of the news. So their current forecast for the fiscal year was $1.51. But here's what they said in their press release. Easy Corp is reducing its earnings per share expectations for the quarter ending June 30th to a range of 29 to 31 from previous guidance of 34. This would be 16 to 24% greater than the 25 cents per share they reported in the quarter ended June 30th. They also, it goes on to say, this represents in full year expectations a range of $1.40 to $1.44. They currently have $1.51. But if you compare that to last year, this still represents a 16 to 19% increase over the earnings that they reported in fiscal 2008. To me, that's really not that bad a news. But let's go ahead and make the adjustments. Let's lower the growth rate from 18% to 15%, and let's drop the earnings from $1.50 to, in the middle of the $1.40 to $1.44. Let's put it at $1.42 for this year and see what happens to their chart. Currently, this is what it looks like with a 34% expected rate of return at 18 times earnings with the $1.51. So let's change it. So now after adding their new guidance of $1.42 and overriding the chart and lowering the growth rate down to 15%, and even if the stock only traded at 15 times earnings in 2014, it would be a $47 stock by then, representing a 27% rate of return. The company has no debt on the balance sheet. It still has very, very strong growth, although disappointing. This company is not going out of business. They're still going to have a great year this year in 2009. It's going to be 15 to 20% above what they did last year. And, again, I don't know what anyone's going to drop the expectations, but I still see this company with a lot of growth and significant opportunities in Mexico continuing to grow at 15 to 20% a year at least over the next 3 to 5 years. So here's a case where, the short run can be so deceiving that right now they're taking out and shooting this company. It's got great financials. It's got good operating history. It's got a great track record, has little debt in the balance sheet, and because of a modest disappointment in earnings, the market has taken it out and shot it. I hope this added some additional perspective. I don't believe there's any possible way this company's stock is worth 15% or more less today than it was yesterday. This is Chuck Carnival. I hope this added some additional insight. As I continue to wipe the egg off my face, I'll be talking to you again on Monday. As usual, I'll take the weekend off, but we will be posting an oldie but goodie. So check us on the weekend if you want to look at some old posts. Thanks for listening, and have a great weekend.